The hardware delivery schedule for quantum systems has created a specific asymmetric investment opportunity. That schedule targets a window between 2025 and 2029 for Q-Day. This is the point at which quantum computers possess enough logical qubits to break the public key cryptography securing the global economy. Google's Willow chip recently achieved below-threshold error correction. In this regime, adding more physical qubits directly reduces error rates, moving the technology from laboratory research to industrial scaling. IBM has confirmed a roadmap to integrate fault-tolerant quantum computing modules into its commercial systems by 2029. Alternative computing modalities are scaling simultaneously. In the trapped ion sector, IonQ's Helios system has already demonstrated 2-qubit gate fidelities of 99.9%. Meanwhile, Quera's neutral atom architecture is specifically targeting 256 error-corrected logical qubits by 2028. Concurrently, companies like Xanadu and PsiQuantum are pushing continuous variable photonic systems toward million-qubit physical arrays. Classical cryptography is expiring on a multi-front engineering schedule. Institutional capital must migrate to quantum-native architectures before the legacy systems reach their predicted end of life. Private hardware developers are only half the equation. Sovereign governments are already mobilizing to replace vulnerable digital infrastructure. The European Quantum Act mandates the deployment of a continent-wide operational quantum-secure communication network starting in 2026. Known as the Euro-QCI initiative, this infrastructure relies on dedicated terrestrial fiber optic lines to connect strategic national sites and secure critical data transmissions. This terrestrial network integrates with designated space segments, specifically the IRIS-2 and Eagle-1 satellite programs, to establish global secure coverage. This space segment carries heavy institutional backing, funded and coordinated by the European Commission and the European Space Agency. The primary objective is the deployment of device-independent quantum key distribution, or DIQKD, to secure physical assets like energy grids and state communications. While EuroQCI builds the physical backbone for state communications, it does not secure the underlying math of the financial sector. Most digital assets remain tethered to the same elliptic curve signatures these networks are designed to replace. Any institutional digital asset must be engineered to natively integrate with this incoming sovereign quantum infrastructure to remain viable. The financial sector often assumes it can simply swap vulnerable ECDSA encryption for NIST's new post-quantum algorithms, like MLDSA. Implementing MLDSA lattice signatures onto a classical blockchain creates massive state bloat. At required institutional security parameters, an MLDSA signature block is 2,692 bytes. This data weight chokes legacy networks. Extra storage requirements degrade throughput, slowing high-frequency commerce to a crawl. The current mitigation strategy involves Layer 2 rollups, using hash-based Starks to process transactions off-chain. These Layer 2 networks use ZK snark filters to compress transaction storage by 90%, allowing for EVM compatibility without bloating the underlying Layer 1. However, even with advanced compression, the system still relies on probabilistic classical consensus to finalize transactions, which carries inherent settlement latency. Lulting on post-quantum cryptography to legacy blockchains fails to meet the specific requirements of institutional finance, instant settlement, and a zero-trust environment. The alternative to blockchain consensus is a powerful new cryptographic primitive known as quantum lightning, which completely redefines digital asset unforgeability. Derived from non-abelian group actions, quantum lightning operates on a system where valid quantum states can be verified by anyone, but can never be duplicated. The generation function splits an input into a classical serial number and a quantum state. Passing this genuine state through a verification node outputs a valid signal, remaining intact. But if an adversary attempts to clone it, the system outputs a mismatch, destroying the forgery. This unclonability holds true even for adversarially constructed states. The laws of physics neutralized counterfeiting at the hardware level. Quantum lightning provides mathematical unforgeability. It eliminates the need for a decentralized ledger to police double spending. How does the network securely mint these quantum states without relying on a central hardware manufacturer? The solution is device-independent quantum key distribution, or DIQKD. It functions as a zero-trust attestation layer. The mechanism involves measuring the violation of Bell inequalities. This mathematically guarantees true randomness and secure key establishment, regardless of who built the hardware. At the physical sensor boundary, this is achieved using a periodically poled lithium niobate crystal. Its structure allows a laser pulse to generate entangled photon pairs. These pairs are necessary to execute the Bell test directly at the physical layer. By anchoring token issuance to hardware-level quantum attestation, the architecture moves trust away from software consensus and places it into the unbreakable laws of physics. We can synthesize these physical and cryptographic layers into an institutional product, a USD-pegged stablecoin operating on a quantum lightning settlement network. While classical stablecoins require minutes to achieve consensus through proof of stake, the QLSN relies on instant quantum attestation. The network bypasses block mining latency entirely because the digital token is the physical quantum state. Transferring the quantum state from the sender to the receiver finalizes the settlement immediately. No network-wide broadcast or independent validators are required. This architecture unlocks high-frequency trading, real-time cross-border liquidity, and automated collateral adjustments without time delay risk. The QLSN enables zero-trust commerce across sovereign borders, immune to legacy issues like network congestion and minor extractable value extraction. A USD-pegged quantum stablecoin is the necessary financial vehicle for a post-quantum economy. Hardware developers are hitting fault tolerance benchmarks, and sovereign governments are laying the Euro QCI fiber networks to protect state assets. Deploying capital into this architecture today is the most direct way to secure high-value transactions against the impending collapse of classical cryptography. The legacy digital asset market operates on speculative software. This architecture operates on physical unclonability rather than the probabilistic consensus of classical software. The infrastructure is being built now. Institutions integrating with quantum-native settlement by 2026 are positioning for a sector projected to generate up to $600 billion in value by 2035. Q-Day is on the calendar, the physical rails are active, and the quantum USD stablecoin is the foundational settlement asset designed for this environment.